Well. What do we have today? A bank in New York struggles, starts to spook markets and revive worries about some sort of a debt refinancing dislocation, and then the Fed comes out and hits the markets once again. One might say we've discussed something adjacent to this here on Macro Money, or perhaps precisely that, in fact. Welcome, everyone. This is Ilya Spivak, head of Global Macro here at tastylive. And although the markets did just about exactly what we said was likely to occur in the wake of this FOMC policy announcement, the story is not over, because the deluge of macro event risk that faces traders this week hasn't concluded. As a matter of fact, there is more on the menu. The avalanche continues. So what we're going to do here today is look at some of the key releases immediately in front of us. We will, of course, save the NFP story for the conversation that we're going to have on the show tomorrow, and we'll dive into that one in detail. But today, a grab bag of macro event risks on the calendar in the next day and a half or so, and we'll see how that gets the story to evolve. We begin in the UK, where we have a follow-on policy announcement. Follow-on, of course, because we've just had the Fed. Now, much of this has evolved in the same way as Fed policy expectations have. There's been a dramatically dovish shift from the BOE meeting in November, seen here in the big dashes, out to December, the little dashes, and as you can see, the current setting, that's the solid line there, very little changed from where we are when the BOE announced policy in mid-December of last year. We can see here the current rate, 5.25. We're looking at, it looks like, stasis at this meeting, of course. That much is clear, because as we look at this implied policy curve, we find rates at 5.18 for the February meeting. That, of course, is what we get today. It'll be February 1st in the UK when this comes out. And stasis in March. So the first cut looks to be on the menu for May, and it looks like we're going to get just about 1% in easing this year. So you can see 5.25 is the current bank rate, 4.17 is where the futures have us in December. That's a decline of just about 1%, with a little bit of optionality, about 8 basis points of optionality for a further cut. So a very slight chance that we get 1.25 in easing at this point. So this is the baseline that we're looking at. And of course, the key thing here will be what the messaging from the Bank of England sounds like, whether they're going to endorse this perspective or whether they are going to push back on it. And the story with UK economic performance has actually started to look relatively upbeat in recent months here. We are looking at the strongest UK economy, looking at the PMI data, in 7 months, according to the January numbers here. 52.5 on the composite index, so that's north of 50, as ever on the PMI data. 50 is the center line where you have neither growth nor contraction. Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. What do we see for the UK economy? Manufacturing has been anemic since the middle of 2022, much as it has for most of the global economy. So that continues to be in contraction mode, but we can see the pace of contraction since about the middle of 2023 has been steadily easing. Meanwhile, the story in services has been one of recovery, a return to growth, and that has, of course, pulled up the overall average composite index because services are a much bigger share of the UK economy, much as they are for most major economies, than is manufacturing. And so, against this backdrop, what we've seen is a sense that maybe the Bank of England doesn't need to move quite so hard. And so when we look at the spread in futures that are looking at where we start this year. By the way, Sonia futures are just the secured overnight rate futures that correspond for the UK to what Fed funds futures generally do in the US. In other words, they bake in within them the expectations for the evolution of monetary policy. And so we can see here in looking at the spread between the rate that the futures imply in January and the rate that they imply in December, how many cuts the markets are pricing in for the Bank of England. And you can see that as of the middle of the year, we were looking at about 50 basis points, give or take. Then, of course, there was that upswell from November to December. So let's look one more time here. When you see the move in the curve from November here, that's essentially right at the beginning of November, almost exactly 2 months ago, down to here, this much flatter setting with lower rates, that of course corresponds to this right here. When we go from about 50 basis points being the sort of peak in the range to 75, give or take. And then, of course, by the beginning of the year, we're all the way down to nearly 6 rate cuts. That echoes a similar thing for the Fed. But, of course, that economic data has indeed looked better. So it looks like we've shaved nearly 2 of those cuts away. So we've gone from negative 144 to negative 1. So it looks like the BOE now on course to do just 1% in cuts. So with the markets thus tuned, the question is, does the Bank of England push back? Now, there's a couple of moving parts to this announcement, not the least of which is the voting tally. The Bank of England doesn't just release a statement, doesn't just give a press conference, all of which is going to happen. It also releases the minutes from the meeting up front. So we'll get those right away. It also releases the voting on the committee. And actually, the way that the Bank of England is different from the Fed is everybody gets a vote, and it's one policymaker, one vote. So while on the Fed, the chair can overrule and generally tries to guide by consensus, but ultimately could make the deciding call, for the Bank of England, the governor, Andrew Bailey, is just another vote. 9 policymakers will vote, and we'll see how that vote tally is going to evolve to try to understand what it means about sentiment on the committee. So the last time we had nobody voting for a cut, we had 6 of the 9 voting to keep things unchanged, 3 of the 9 voting to raise rates. What we're looking at this time is maybe only 1 more voice for rate hikes, 8 of the 9 voting to keep things steady, and again, no calls for a cut. If we get fewer people moving into the neutral column, so let's say it's not 3 of 9 calling for a hike, and not 1 of 9, but 2 of 9. Or let's say it stays at 3 of 9. That would be something that the markets would perceive as relatively hawkish. And of course, the data seems to have generally argued that the Bank of England need not be in the kind of hurry that, let's say, the ECB is. We'll talk about that in just a second, to go and hike, or rather to cut rates. So if the Bank of England strikes in sort of the full breadth of the materials that they're going to release here, between the minutes, the policy statement, the press conference, if they're going to give us a sense that they are not in a hurry, then the conclusion might be that 1% is still a little bit much. And that what we might need to do is maybe get back closer to something like 75 basis points. And with that in mind, there might be a reaction from the British pound, which has pointedly sat in this range here. Right above 128 seems to be the top, right above 126 seems to be the bottom. It looks to have ended whatever up move this was, but it's pointedly not declining. And so what we could be looking at here isn't so much a reversal down as it is a period of congestion and digestion before the next move higher is going to play out. Now, of course, if the Bank of England does decide to strike a more dovish tone, then we might get a break through this support, and then it looks like the next key level is about 125, and after that, right around 124, maybe a bit lower. On the top side, if we take out this range top here, and we end up north of this high, just above 128 and change here, the next level up is basically a test of the 130 figure. So there is some momentum for this to continue if we get north of this range top. So that'll be something important to watch. Now, maybe the Fed's policy announcement today, where it looks like there's some pushback from Fed Chair Powell on the possibility of a March cut, maybe that gives us less of a impetus for the pound. Maybe it struggles to make good on the BOE, but it will be that range top that should be the deciding factor on where momentum ultimately finds itself. Then, of course, we swing right back to the U.S., where we are going to get one of the more important economic indicators here. This is the ISM manufacturing survey. It works just like a PMI survey from S&P Global, the usual publisher of PMIs. ISM, the Institute of Supply Management, focuses generally on the U.S. and Canada. And here we're expecting to see yet another month of contraction. As we just said, manufacturing has been in contraction mode basically since the second half of 2022 globally. And of course, that's exactly what we see here. The overall index is the yellow bars there, and you can see it's below 50 and has been below 50 since basically the second half of 2022, much as we just saw with the UK. It is expected to stay there. The inputs remain in contraction mode as far as expectations are concerned. Here's where they're expected to evolve. New orders, employment, and prices, all of them expected to shrink at a slightly lower speed, but nevertheless remain in contraction mode. So expectations here really not very controversial. Where this gets interesting is U.S. economic data has tended to outperform relative to forecasts by an increasing margin recently. That's according to data put together by Citigroup. And what we see here is we seem to have basically gotten right on top of expectations at the turn of the calendar year. There was a significant upshift in U.S. growth forecasts between essentially August and the end of the year that basically raised the bar for the data to beat relative to forecast. And so this index came in, not because the US data got worse, but because the forecasts themselves were increased. And so it became more difficult for the data to beat relative to those forecasts. This is an index where values above zero suggest the data is beating, and the further it goes, the more the margin of upside surprise. It's, of course, the other way on the downside. If the number is negative, then we're surprising on the downside, and the further negative we go, the more the margin of disappointment. What we see here is that the margin of positive surprise has been increasing recently. That, of course, reflected in spades by last week's GDP numbers, my numbers, this week's JOLTS report, and the Fed itself. Fed Chair Jay Powell was all kinds of upbeat about the economy when he spoke. And so the possibility here is that this ISM manufacturing data follows suit, that it gives us another example of U.S. economic activity barometer showing better than expected results. But of course, in the wake of the Fed, we see what that means for markets. We've been talking for quite a while about how this relationship between stocks and the Fed policy outlook is going to evolve. And what we've been saying as recently as yesterday on Macro Money, ahead of the Fed, of course, is that in the third quarter of last year, there was a clear dynamic where the stock of expected rate cuts for 2024 was diminishing. Stocks didn't like it, they were going down. In the fourth quarter, the stock of rate cuts for 2024 was expanding. Stocks did like that, they were going up. As the stock of rate cuts in the forecast seemed to peak and started to hem in again, the expectation might have been, based on earlier performance, that stocks wouldn't like it. But they actually pushed to record highs. And so there was an understandable question as to whether the markets now don't mind fewer rate cuts. But if we looked at the dynamics, and we cautioned yesterday when we were talking about this is not a statistically significant set of instances, and so you have to take this with a grain of salt. But every major turn in this policy cycle, in the expected number of rate cuts and the transmission then to stocks, has had about a 2-week lag, about half a month lag. And so we see here, for example, rate cuts are fading, stocks are going up. The peak in rate cut odds is here. They start to fade. Stocks are still going up for 2 more weeks. It is there that markets finally recognize, oh, this is going to continue. And things come down. It's the same the other way around. Here is the trough in rate cut odds. Again, about 2 weeks later is when stocks begin to turn higher. Well, we were just about 2 weeks away here. Here was the peak. Things still kept going up through here, and about 2 weeks later, there is the turn. And ostensibly, it is motivated by the Fed coming out and saying, yes, we're going to cut. It's just not going to be nearly the amount that markets have baked in. We are much more reluctant to ease, though we think we are going to, than markets are anticipating. And so it's a question of degree and of scale and scope rather than direction. With that in mind, stocks don't like it, they come down. As it happens exactly, or almost exactly, 2 weeks after the peak, just like the prior instances that we've discussed. So what we see then, if we get ISM data that's better than expected, is yet another instance of a piece of news that says the economy is doing well. We don't need aggressive rate cuts. The Fed is right to move slowly. It is right to take its time. And that does not seem to be something that the markets are liking. And so that represents a risk for stocks and maybe important stage setting ahead of the non-farm payrolls report due on Friday, where again, everybody's going to be focused on whether the report endorses the market's view of easing, which is more dovish, or the Fed's, which is clearly more hawkish, in which the markets, as we can see from performance today, the markets do not like. The US dollar likes it. It's been going up consistently since this bottoming right here. That delay that we just talked about, that 2-week transmission mechanism, the dollar isn't doing that. It's moving in step with policy bets. Stocks, on the other hand, seem to be taking their time to digest and transition for about 2 months between these turns, or 2 weeks rather, between these turns. And we'll see if that pattern continues. Nevertheless, if we do get better ISM data, the performance that we see today would imply further weakness in equities and further strength in USD. And finally, Eurozone inflation. Here, too, the expectation looks to be relatively benign, coming down from 2.9 to 2.7% on the headline inflation reading. This is the harmonized one that is most relevant for the ECB because it's the one where the ECB uses one yardstick to look at the entire Eurozone. Some countries in the region actually put out 2 sets of CPI data, one that is their national benchmark, one that is their version of the ECB's way of calculating. And the lead up into this actually was German inflation data that we saw come across the wires here in just the past day. And there was an outsized move lower on inflation. Inflation came in more than expected. The harmonized version of Germany's data, Germany is one of these countries that releases 2 different sets of CPI, and on both of them, there was more disinflation than expected. So on the headline, we went from 3.7 to 2.9%. The expectation was we'd be at 3, so 2.9 is lower than expected. On the harmonized, we went from 3.8 to 3.1. The expectation was 3.2. So again, 3.1 is lower than 3.2. More disinflation in Germany, the region's largest economy, than markets had penciled in. That probably sets the stage for something similar on the region-wide metric. And so what we might see is perhaps even a bit of a downside surprise. Maybe we don't come in at 2.7. Maybe we could come in at 2.6. But suffice it to say, the ECB has the ingredients, and we've talked about this in detail before on macro money, has the ingredients to be cutting. So it has inflation coming down. The largest component of it is food. That's the bright magenta there. And food prices tend to lag into CPI with about a 7-month transmission. So we can actually see that food prices have continued to fall, and there is a runway for them to continue to be edging lower in the CPI calculation over the coming months. So there's runway here for continued disinflation. Meanwhile, the Eurozone economy remains in recession by almost any way you slice it. The GDP numbers were stagnant this week rather than outright negative, but looking at the PMI data, we've been in contraction for 7 months in a row. So not surprisingly, really, the markets are expecting that we are going to get cuts. We can see that there's been the same November to December dovish adjustment that we've seen everywhere. The first cut we can see on the menu for April at this point with some optionality for March. And if we look at the 12-month stock here, as we've done before, we can see that it seemed to peak, as it did much of everywhere, at the turn of the year at about 1.5%. It's narrowed in as it has elsewhere, but unlike the BOE or indeed the Fed, it's blowing back out as the markets expect the ECB is going to be that dovish, is going to err on the side of more cuts. And so if we get CPI data that registers a bit softer and endorses this, then the euro might very well make good on the break of this 4-month rise here. So you can see we're trying and trying to get through this support. And if we do, we might well be looking at lows closer to 107, somewhere over here, as the next key inflection point, maybe just above 107 as the first stop. So while the pound may well go higher when the Bank of England balks at rate cut expectations, data from the Eurozone suggests the euro may well go the other way. And that is Macro Money for today. As ever, we're here Monday through Thursday, right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, talking about the Wall Street close and where things are going thereafter. I'm back on with Chris for Futures Power Hour on Fridays, on with Tom and Tony for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter, @IliasPback. Thanks very much for joining. We'll talk NFP tomorrow. Till then, take care.